We are coming into the last week of September, and investors are facing some tough choices on how to position for the final quarter of 2023. On the heels of 3 weekly declines, traders are bracing for a breakout in the VIX, the CBOE Volatility Index, forcing even lower prices, or a reversion to the mean, relieving oversold conditions, letting stocks take back some of the losses. I can't pretend to know what's coming this week, but I can make decisions on how to position my team for the final quarter of the year. New information comes in, and you're forced to adapt. You roll with it. When the most important market player on the planet speaks, investors are forced to listen. Fund managers have spent the last several trading days dumping exposure, or at the very least, repositioning for higher rates that could be with us longer than we thought. On Wednesday, Jay Powell and the Federal Reserve moved the goalposts, indicating that the Fed rate cuts are now delayed another 6 months. Monetary policy is up against fiscal policy so out of control, it could be even longer than that. In fact, if they do cut rates, it could be for all the wrong reasons. Welcome to The Money Runner. I'm David Nelson. Tactical strategies, which are generally trend following, have more than likely put the defense on the field, aiding to short ETFs or raised cash. Stock managers can do the same or factor tilt their portfolios to what's working now. On the tactical side, there's little choice, but on stock strategies, the latter keeps me in the game and out of the business of market timing. To be fair, the goalposts have been moving since the start of the year. We came into 2023 with an expectation that the Fed would take their foot off the brake by November. In fact, by March, on the heels of a mini banking crisis, that expectation quickly moved up to July. Since then, week by week, the goal of a Fed ready to slowly retreat to neutral moved out further, with last week's FOMC decision and press conference causing the most damage. Overnight, any chance of 100 basis points of easing next year evaporated, putting into question if we could even expect 50. As you would expect, large cap secular growth took it on the chin, always the first to fall when the risk-free rate moves in the wrong direction. 10-year rates broke to a new cyclical high, forcing investors back to the fundamental reality that the first input of most valuation models is the risk-free rate. Throw in a government shutdown likely at the end of this month, we were probably lucky the S&P 500 was only down just shy of 3% last week. I'm convinced the Fed is done hiking, and if not, they are very close to target. But what is becoming increasingly uncertain is how long rates will stay in restrictive territory. That uncertainty forces change, a change that actually started a few months ago. Suddenly, value and quality are important again. Last year, one of the most important factors for investors was free cash flow and dividends, both of which are today getting a lot of attention. No, it doesn't mean you need to sell all of your Microsoft and Apple, but it does mean you should make some room for sectors and stocks that could balance out what is largely a tech and growth dominated index. So how does Washington play into this? Without question, the coming election will focus heavily on Washington's spending as well as ballooning deficits and debt. However, there is little that can be accomplished without a bipartisan effort. Even in a unified government where one party controls all the major branches, politicians are up against a Washington bureaucracy so entrenched, cutting spending will be difficult, if not impossible. Depending on the source, there are approximately 2.1 million civilian employees working in the federal government. Of those, only 4,000 are appointed by the president. Any incoming president, even with a sweep of both the House and Senate, would still be up against more than 400 federal agencies, each with a budget and all wanting a bigger budget than they had the previous year. What could force the Fed to cut? The most obvious would be a recession. Much has been made about the Fed engineering a soft landing, a scenario I have not endorsed. The more likely way this plays out is sometime next year, the economic drag of high rates will force the inevitable. Remember, when the Fed started hiking rates in March of last year, the Fed funds real rate, which is the Fed funds rate minus inflation, was minus 800 basis points. While it feels like the Fed has been restricted for 18 months, the truth is it's only been 6. No question, employment and the consumer have been resilient, but now as COVID stimulus has run its course, cracks are starting to develop. The toxic mix of higher inflation and rising consumer interest rates, which in turn drives increased delinquencies, eventually will take its toll. Yes, many of you will say nothing can stop the U.S. consumer. That sounds like one of those sayings that works right up until the time it doesn't. There comes a point where even the all-powerful U.S. consumer hits a wall that is likely just around the next turn. So what should you do? If you haven't already, bring the average PE multiple down on your portfolio. If you don't have cash, make some room and pick some stocks with some of the above attributes. High free cash flow and dividends will also help. Even if your favorite names bounce this week, start planning ahead. It's not going to be surprising to see a move higher in most of the large cap secular growth players. Coming into this week, most are sitting at the bottom of their ranges. Remember, reversion to the mean is a powerful force, and without question, there's been some pretty intense selling. If you're balanced already, then weather the storm. There is still a ton of cash on the sidelines waiting to come in, offering some support if in fact this market falls further. Here are some trades to think about. The administration's push against large cap pharma and the healthcare sector as a whole, that's been well telegraphed. But like I said earlier, there are limits to what the executive branch can accomplish on its own. We still have a divided government. Healthcare is a growth at the right price sector offering reasonable valuations, free cash flow, and in most cases, dividends. The very fact that utilities are starting to outperform, that's also a red flag. And finally, energy has been the leading sector for months, offering high free cash flow yields and dividends. Oil's not in the 60s anymore. Winter's coming, and Saudi Arabia has regained its crown as the swing producer. Even within technology, there are a lot of stocks not trading at nosebleed valuations, and most will benefit from the boom in AI. I'm not going to give you specific stocks to buy. First, by the time you see this podcast, the story may have changed, or the opportunity has passed. And two, it really needs to be a personalized one-on-one conversation with me or someone on my team. The coming months will no doubt test our resolve, our strategies, and our foresight. We are the architects of our financial futures, but with that responsibility comes the necessity to push back and question our decisions each and every day. I'm David Nelson, and this is The Money Runner. As always, if you like the pod, in fact, even if you didn't, hit subscribe. I might get through to you next time. And don't forget, visit us at themoneyrunner.us. Thanks for joining.